Hey guys, Mr. Flanagan here. Getting an assist from Mrs. Flanagan holding the camera for us. If you want to say hi, there's her thumb. So this is a video showing you an example of bank balance sheets. You already have this question, this example in or on the last page of your practice packet. So I'm not going to spend too much time showing you the questions because you can reference and I'll call out the numbers and the letters we're working with. So we have assets right here, which are things that the bank owns, and liabilities are what the bank owes. So this is a bank balance sheet. It's basically a T-chart that both sides have to equal each other. This is how banks keep track of required reserves and excess reserves and how many deposits come in. So demand deposits reference the deposits that customers are making or that are already in there. In our case, $100,000. The equity we can forget. If it ever says something about like business furniture or something, forget that too. Completely distracting. So on this side here, the assets that the bank owns, they have $10,000 in required reserves, $5,000 in excess reserves, and then $85,000 already loaned out. So we know if the bank has already loaned money, they can't re-loan a loan. So this money we also cannot touch. And then again, we're just going to ignore that section right there. The reason why we say this is a liability to the deposit is because customers could come in at any time and demand their $100,000 back. And then over here again, the required reserves and excess that we spent some time on already. So let's dive right in. Part A, first question seems fairly simple. What is the reserve requirement? You're not just going to list $5,000 because clearly they assume that you can read. So that's not going to be that easy to get a point there. What you need to do is give them the percentage, the actual required reserve ratio. So the percentage. They already gave you the dollar. Now, the required reserve is the percent that banks must keep in the vault of every deposit that comes in. So if there were deposits of $100,000 and the required reserves that the bank is currently holding are $10,000, the way we can figure out the percentages, well, how many times does the smaller number 10,000 go into 100,000? Well, that's pretty simple. To get from 10 to 100, we multiply by 10, and that's our answer. So for part A, if the bank is currently holding $10,000 as a result of $100,000 in deposits, which was given to us in the chart, again, in order to get there, take this number times whatever it takes to get to the number deposited. That is our percentage, and that's it. That is already a +1 on this FRQ. And we don't want to forget this number, so when you write that down, don't forget that 10%. Treat that like the required reserve for the rest of the question. So the next part, B1 or BI, it says assume that Luis withdraws $5,000 cash from his checking account at the bank. So a customer is taking out $5,000. It says by how much will this bank's required and excess reserves, typo should be in there, change based on Luis's withdrawal? Now this is a really annoying question because it's really testing something really minuscule. And from this point on, they've never asked it this way. But we know that the required reserves plus the excess reserves are called the total reserves. It's really annoying. So we can think about this right here like total reserves. Required and excess reserves are the same thing as total reserves. So it's really asking by how much do total reserves change as a result of that withdrawal? Well, if he took out $5,000, the bank's total reserves decrease by $5,000 because a customer came in and took money, his own money, which he's allowed to do, out of the bank. And that's it. Again, the reason why we can interpret required and excess reserves, that's supposed to be interpreted as the total reserves. So part B2, what is the initial effect of that withdrawal, that $5,000 withdrawal, on the M1 measure of money supply. And then explain means we got to give an extra sentence or something like that. So the M1 money supply includes cash or currency plus, I'm just going to abbreviate, traveler's checks, but this is really the big one, checking accounts. Cash and checking accounts are both included in M1. So if a customer takes $5,000 out of a checking account and takes it as cash, there is no change in the M1 money supply. That gives us our first point. The second point, the explanation, is, if that wasn't super clear, we can think about it this way. If we break it down, we have, if we just call this money supply, we'll do kind of a visual diagram here. Money supply, before Luis came and took out money, there was $5,000 in a checking account and $0 in cash. I'll put that up here. Cash. So the total money supply was $5,000, $5K. After Luis takes out his $5,000, there are $0 in the checking account and $5,000 in cash, which still gives us a total M1 money supply of $5,000. Those two numbers are the same. So this is just a visual representation of why we can say that there's no change in the M1. Essentially, we're just recategorizing, putting different labels on something that's already included in M1. Cash is in M1 and checking accounts. So the actual M1 money supply itself did not change. Now we're gonna, clear a little bit. Bear with me. Again, normally I do this on the PowerPoint slides, but the whiteboards make it a lot easier than trying to click through and preempt everything. So our last question you have is B3. As a result of that withdrawal, what is the new value of the excess reserves on the balance sheet of this bank? So actually what I'm going to do is I'm going to have us focus on the piece of paper here. So Luis came in and took out $5,000. That means instead of there being $100,000 in liability, there is now $95,000. Because he came and took $5,000 of his own money, the bank is no longer on the hook for that. So the bank is only on the hook now for $95,000. Now the first thing is, well, where's the bank going to get that money from? Well, the bank cannot give out their required reserves. They have to keep their required reserves. So the $5,000 that they're giving Luis is going to come from right here, the excess reserves. So when Luis first comes into the bank, they give him his $5,000, there's our subtraction, from the excess reserves, because banks are not supposed to touch these required. They need to keep it in there by law. That's our fractional reserve banking idea. However, the question says, what's the value of the new value of excess reserves based on the reserve requirement from Part A? So remember I told us not to forget from Part A, we calculated that it was a 10% reserve requirement. So now we need to look back at our required reserves and our demand deposits. So basically what's happening, we'll shift back over here to the whiteboard a little bit. Arrow. After he took out $5,000, there's $95,000 left, which means the bank needs to keep 10% of $95,000, not the original 100, because they're no longer responsible for all 100. So again, how can we figure out 10% of a number? If we take out those nasty commas, 10% of a number, take off a 0, gives us $9,500 that must be kept in required reserves by the bank. However, the question asked us about what is the new value of the excess. Well, if we go back over here to the chart, after the withdrawal, the bank only needs to keep $9,500, but they are holding on to the original $10,000. So banks want to make profit. So what they're going to do is realize, oh, cool, we only have to hold $9,500 now because that's 10% of what's in our demand deposits. So whatever the difference is between $10,000 and $9,500 becomes the bank's new excess reserves. So $10,000 minus $9,500, quick head math there, means $500 can be loaned out by the bank. So our answer for part B3 is that the bank's new excess reserves, which can be loaned out, they're the excess or the extra, is $500. Now, that's the end of this FRQ, but one note I want to make down here near the bottom in our little cloud right here. This is just a note because most FRQs will actually ask you to use the Money Multiplier at some point. So this is just a recap because I know some of you stopped that fractional reserve banking video early. You didn't make it all the way through that 20-ish minutes. So if a part of the FRQ asks you, based on this $500 new excess reserve, how much new money can be created, or how much does money supply increase by? What you do is the Money Multiplier, 1 over the required reserve ratio as a decimal times the excess reserves. So for our question, if they asked this, which they did not, this is just a hypothetical trying to help you with other FRQs, you would move over here and 1 over the triple R, if 10% is the required reserves, that as a decimal is 0.1. Our new excess reserves were